Latest global liquidity update. Our global liquidity index hit just over 60.8 against a normal range of 0 to 100 at the end of last month. This fact suggests that markets will be buoyed by liquidity, but the overall index disguises two interesting facts. The first of those is that private sector liquidity is far more buoyant than central bank liquidity, somewhat contrary to market beliefs. In other words, central banks are not supporting Western markets in the way that many investors think. On the other hand, private sector liquidity coming from corporations, from savings flows and from credit flows from banks are actually far more important than the market expects. That will likely underpin economic activity going into 2014 and supports our view that the world economy will enjoy a cyclical recovery, probably slightly faster than current expectations would suggest. If you drill down into the data further, one finds a second interesting fact, somewhat contrary to market expectations as well. And that is that Western liquidity, in other words developed market liquidity, is again far more buoyant than emerging market liquidity. Our overall developed market liquidity index stands at 70.8 against a normal 0 to 100 range, whereas emerging market liquidity on the same scale is a miserable 16. This difference largely explains why emerging markets have underperformed substantially this year, and we believe that weakness in emerging market liquidity can be traced back to the weakness in Chinese capital spending. It will have, we think, a significant implication once we get into 2014, because weak emerging market liquidity is likely to drive emerging market economies slower. That slower growth may well feed back into Western markets in this sense. Many large defensive growth stocks have been the main engine of developed market asset price rises, particularly the rises on Wall Street. If there is any compromise or weakening in emerging market growth next year, that will likely feed back negatively and lead to a derating of many of these large growth stocks. On the other hand, the prospect of faster capital spending in the West will propel cyclical value stocks higher. Therefore, we think now is an interesting and probably prescient time to start making a relative shift within asset markets.